With the U.S. indices near all-time highs, yet facing increasing volatility, increasing uncertainty, some investors are looking to a potential safe harbor. They're looking for potential value investments that might protect them with more volatility. So this got my interest when Dimitri, a premium member of the Unrivaled Investing community, asked me to look at Howard Marx's portfolio and his big bet in Torm stock. TRMD is the ticker, representing about a quarter of their $5 billion plus public equities portfolio. For those that aren't familiar, Howard Marx is the founder, one of the founders of Oaktree. Oaktree is now owned by Brookfield, but Oaktree has a deep value focus. So this is not a growth at any cost type of investor. This is a investor that's looking to find deep value, not hyper growth. And the deep value oftentimes means, hey, can I find something at 50 cents on the dollar or less that I think is very likely to be worth $1 in the future, and having a long-term mindset. Now, sometimes it'll even involve some sort of, complex restructuring where you're buying bonds, and through those bonds, you're effectively buying that dollar at 10 cents or maybe 20 cents. And hey, if you can do that enough times, you can generate a great return. And that's what Oaktree has done over time. So I am interested in what's going on with Torm, especially when I see that over the last 6 months, it's gotten quite a haircut, losing about 50% of its value, trading around 2 times price to earnings, a 30% dividend yield. Okay, so what are they doing? Is this dividend yield sustainable? What are my thoughts on Torm? Let's dive into understanding what do they do. By the way, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. I'm looking for potential multi-baggers, the types of stocks that can go up hundreds or even thousands of percent over time. I'll talk about my checklist towards the end of this video in terms of, what's right for me on my own personal investment journey, because everyone's different and they're looking for different things. So let's go through what Howard Marx at Oaktree might be seeing with Torm. So Torm, they operate a fleet a little under 100 tankers around the world, 3,400 seafarers operating these ships. And you're talking about long range and medium range vessels shipping refined oil products and chemicals around the world. And you can see that this company has over 100-year history dating back to 1889 with Ditlev E. Torm. And then, you're talking about a Copenhagen stock exchange listing. And then Oaktree, this gives you a perspective of the mindset that Oaktree has. This is not a short-term day trader. They first, were getting involved with this company about a decade ago, and they entered a deal where they contributed 25 vessels to this new co, and they also did a restructuring. So they were investing in the bonds of Torm. And so through that, they have emerged as majority owner. Now, I think they've been selling down their stake a bit, but as of the most recent update, it appears that they still own around 40% of the company. So still one of the largest holders for Torm. So let's understand what's going on here. So we understand it's a tanker company with around 100 different tankers, and they talk about being a pure play product tanker. So that means, they're tied very closely, here it is, to the spot market. So what effectively you can lease these tankers at, and they talk about superior economic results through, one platform where they manage all their ships, and they're targeting creating shareholder value, talking about long-term returns and growth, and paying out their free cash flow as a dividend. So given that Oaktree appears to be the largest shareholder, there is some alignment with the minority shareholders that there's less risk that they're just going to do some crazy, like, hey, we're going to own the biggest fleet. That's not their aspiration. If your goal is to own the biggest fleet, your return on equity, your return for shareholders might be really low. The fact that they're talking about, hey, our focus is on long-term returns, and that you have a smart shareholder, there is alignment with, let's say, smaller investors that are interested in getting involved. Now, one of the dynamics in the shipping industry is that, as the ranges of the trips change, it'll obviously impact the number of boats that are and the amount that you can charge. And one thing that impacted the recent rates is the sanctions against Russia, where, if you have a bunch of European countries no longer getting oil from or gas from Russia, then you're going to start getting it from other places. And that requires longer shipping routes. And then Russia is no longer sending it to Europe. So then they're, sending it to South America, and they're sending it to Africa, once again, requiring more ships for longer routes. And so that is something that benefits shipping rates, another, aspect to consider. So this does reflect. So you have a global shipping market in terms of what's the rate for long range and medium range boats. Then you have geopolitical dynamics that are going to impact those rates. And then you layer in another aspect, which is supply and demand. What is the number of boats? What's the demand for the underlying good that's on those boats? The oil, refined products and chemicals. So another example of geopolitics is you had the Houthi terrorists, firing missiles at boats, cargo ships. And so then they're going to go, okay, we're no longer going to go by the Red Sea. We're going to go by the Cape of Good Hope. And yes, that's a much longer trip to send the goods. And so if you're talking about longer trips, ultimately that means you're going to have a greater demand for more ships, ultimately higher rates for those vessels. So that's, it's showing a before and after in terms of what the trip used to look like, and now a much longer trip just to avoid some terrorists. And it's important to reflect on if you have different types of leaders, and one leader that's like, hey, I won't take this nonsense, and if you fire missiles on a shipping route, I'm going to wipe you out, not holding back at all. That will change shipping prices. And so one could argue the incoming election of Donald Trump is going to impact shipping prices lower because of this. You're going to have more straightaway routes because the expectation is that, he's not going to, pull any punches if he has to. And so you can see the historic shipping rates and Clarkson's, I think, is the company that aggregates all this data, and for the medium range and long range benchmarks. And you can see how it's the dotted lines shows how it's sort of varied over time. During COVID, it shot up. Then, during the subsequent recession, you saw the rates go down, and you see these are the averages versus where, it sort of bounces around. And you could see subsequent to the recession, where we emerged out of the lockdowns, you saw rates ended up much higher, plus that invasion, the Russia's invasion in Ukraine, combined with the Houthi terrorist attacks, you see that broadly rates are higher than even during COVID. So looking at tanker rates, very favorable to prior peak conditions. But if you were to say, hey, what does it look like during a recession or, previously downturns, let's say oil price crashes, what does it mean for the long-term earnings power of this business? And I think it is important to reflect that this is ultimately a price taker. And every investor has to figure out their own journey. Personally, I don't like commodity type businesses. I don't like price takers when you're a price taker, someone else is effectively dictating your journey. And by someone else, it could be a bunch of other shipping companies that say, hey, we're going to rapidly expand our fleet. Well, rapidly expanding your fleet impacts the rate that you can charge for your ships. So that's what I mean by price taker. I do not like those types of companies. I prefer this is our price, give it or take, take it or leave it. And by the way, we have a little bit of pricing power and we expect to raise rates each year. That's the type of investment or type of business I'm more interested in. And you can see, how the different rates have fared over time. The red line is 2024, and you can see it's broadly, I think, heading lower versus where it's been the last few years. The dotted gray line is sort of the average. And so it's, at one point earlier this year it was higher. Now it's trending lower than the average. And so this is sort of a concern, is where does it go in the future? What are my thoughts on Torm based on these dynamics? First of all, as always, this is not financial advice. Also, quick plug, recently Michael, a premium member of the Unrivaled Investing community, shared the following. This is a direct quote. So far, the subscription has paid for itself in 3 months. It's a direct quote. This follows Robin, another premium member, saying the information services you provide to me are invaluable. He's talking about Unrivaled Investing. If you're looking for compelling investment ideas, come check it out, unrivaledinvesting.com. So just a few days ago, December 16th, one analyst posts that commodity shipping rates sink to new 2024 lows, asking, do lower spot rates signal a broader deceleration of the global economy? So there is this concern that rates have continued to worsen, talking about LR2 rates, so the long range 2 product tanker spot rates, currently around $25,000. This is a lot lower than where they were operating at earlier for Torm, where you're talking about $40,000. So this is a sizable haircut. This is down 50%. on the year based on the same Clarkson's data. It looking at medium range, also down significantly, over 30%, down to around 28,000. So this is arguably sizable headwind that Torm is going to be facing. You haven't yet seen it in the results. This is based on the current spot rate, which will flow through in the coming quarters. They need to work through their existing contracts. Their presentation did talk about, as I already showed, that they are heavily tied to the spot market. So those contracts will flow through very quickly. And this new lower spot rate, because of either increased supply of vessels or weaker demand for the goods, or just a dynamic of the shorter traveling distance because of perception of lower geopolitical risks. You have all these different dynamics, but the key performance indicator that you need to follow that sort of drives the returns is what is the shipping rate doing, and that's near lows. That's going to impact their results in the coming quarters. So looking at this business, I think it's just really tough. I already said I don't like commodity companies. I don't like price takers. You can see in 2021 during the recession, their operating cash flows, or their EBITDA, was around $140 million. This is before their $40 million in interest expense. And you can see just how the improved rates just dramatically changes the profile of this business. It's a multiple difference from $140 million to around 850. This wasn't like they doubled their ship count. This was primarily because of the leverage on what they get from the shipping rates. And to go from $100 million to $800 million, that's a big difference. And you can see it in their cash flows as well, from 50 million to 800 million. So it's just a big difference, a 20x difference because of the shipping rates. That is just so important for investors to understand. That is super tough. So when I look at it, thinking about, they're paying hundreds of millions of dollars in dividends, just this past year. And once again, going back to the fact that, it's driven by the fact that their, cash flow is benefited nicely from higher shipping rates. But could you get back to, one of these types of lower rates where you're not generating hundreds of millions, but maybe generating just 100 million? Well, if that's the case, then I think it's a lot, it's unlikely to see the dividend where it is, this $100 million plus per quarter in dividend payments, that could turn into $100 million per year. So you could have a sizable dividend cut, for Torm in the future. However, it would surprise me to see Oaktree continue to sort of trim their stake, because you can see their net asset value per share. So the way to think about that is look at the value of the ships in terms of how much did it cost for them to acquire them, what are they marking their ships at, less the costs of their debt, less the total debt outstanding and any other sort of liabilities. And they're saying net all that out, the net asset value of this business. Now you're probably throwing in some goodwill and stuff like that, but overall the net asset value of this business is around $35 per share. And that's what they're saying based on their most recent report. Things changed a little bit. They acquired, I think 2 more vessels, but ballpark you're talking about that, around $35. And so here it is, when you're looking at a share price around 18, that is the market saying, like, there's a big disconnect to what these ships are worth right now, suggesting once again either oversupply, weakening demand, or shorter routes because of lowering, geopolitical tension. So the reason why I'm sharing all this is, number one, it's always interesting to see, these types of situations, 2 times PE, 30% dividend. But I think it's important for every investor to have their own journey, because this might work out well from here. I think the deep value investors like Oaktree might say, hey, we've already invested for the last 10 years. Once again, it's trading significantly below book value, like a 50% haircut. Maybe it gets reset to, book value again sometime in the next decade. I just don't like that approach to investing. I recognize that it can work well because it protects your downside. My own personal investment checklist is I want to find a line management, which you have here, because arguably you can swap out management with shareholders. And when you have a sizable shareholder, 40%, that's smart and thinking about creating long-term value, you do have that alignment. So even if I were to consider buying shares, I do have faith that they're not looking to necessarily screw over the minority shareholder. They would be looking to say, hey, we're looking to create long-term value. It's not about empire building. It's about creating value for shareholders. So from alignment, I feel pretty good. Compelling valuation, I understand it, trading under, book value. Obvious growth potential is a bit trickier. And that's the one where ultimately it fails on my checklist, which is saying, can you say with 90% certainty that this business should be bigger 5 years from now and be significantly bigger 5 years from now? And I just don't think I can do that. I don't think it's obvious to me at all. And I'd say the shipping rates and the current discount to book value also suggests that. And so this is why every investor is going to have their own journey. This is an important part for my own personal investment journey. And that's why, I just did my second exclusive video for my Unrivaled Nation yesterday. And two of the three ideas, you could argue 3 out of the 3 ideas, it's fairly obvious that management owns like 40% of the company, that they're saying this is how we easily double the company over the next 5 years. So I would much rather take that bet, pay 10 to 15 times free cash flow, where I'm saying, yeah, management has a lot of skin in the game and there's a clear path to doubling the fundamentals of the business. Now, you might say this has the compelling valuation, so that way shareholders could see a double over time because it goes from half of book to 1 times book. But I would rather buy something closer to, 0.9 times book or 1 times book and be very confident be very confident that book value should increase by 50% or 2x over time. And so looking at this blow up risks, I don't think you really have to worry about it. I mean, you could have continued rate pressure. I mean, they do have a little bit of debt, I think around 900 million in debt, but given that their fleet of ships was valued around $3 billion, that should be able to cover their debt. Plus Oaktree, after all this time, worst comes to worst, you throw in another $50 million if you needed to, something like that, just to make the lenders happy. So I view this as it checks most of the checklist, but it fails on that key item, which is obvious growth. Once again, every investor needs to have their own investment journey. Some people will just gravitate towards these types of deep value plays and they'll feel comfortable in it. Personally, I would rather have the obvious growth where most companies, you can't do it, where you can't say, this is like 80%, you have 80% confidence that this will be much bigger in the future. Because oftentimes there's that trade-off of, well, the valuation's just not compelling. It's obvious, but the valuation's too rich. So every investor needs to figure out what's right for them. I hope this video talking about Torm, Howard Marks, the deep value approach has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.